Hi, my name is Nick Lewis, I'm head of the dealing desk. I'm here with Angus Campbell, who's sitting in for Bill on the weekly market view. Angus is our head of market analysis. And Angus, the markets this week, where do you see what was the main driver for the continued rally?
Well, I mean, obviously last couple of days,
last couple of days aside.
Yeah. But yeah, certainly a really good January. So here we are, last day of January. This is potentially going to be, if we close around these levels, it's going to be the third best January for the FTSE since its inception. So that's really good news. And there's this sort of great historical basis called the January effect. If you have a positive January, then historically there have been many more positive years as a result of that good January. So it's positive for the stock market, and really on the whole sentiment's been very strong throughout the month ever since the fiscal cliff deal at the new year. So some really good signs that there may be a positive year overall for equities throughout 2013, but of course just the last couple of days we've sold off a little bit. So maybe a little bit of profit taking actually, considering FTSE up nearly 7%, why not?
And yes, it hasn't come far off the highs, really, has it? I mean, if you relative to the rally for the month today.
Well, exactly. What, some sort of 30, 40 points or so?
I think maybe a bit more. I think it got up to sort of 63.50 in the FTSE cash. I was back to 62.90, but obviously, as you were saying, new high since 08.
Yeah, in the grand scheme of things, not a big pullback. I think that there's a couple of contributing factors. Obviously, yesterday is that GDP number from the US, obviously not very good at all, although a lot of that was down to defence spending cuts. So really nothing structurally concerning about that number at all. I don't think we're going to see a recession, an official recession in the US. But also there's been some bad corporate news today. Deutsche Bank missing, Santander missing, and then the oil major Royal Dutch Shell missing as well. So that's kind of brought down some of those heavyweight sectors. And I think really maybe a bit of window dressing at the end of this month. A few people just thinking, thanks very much, I'll bank this profit. But I suppose what's been interesting is really how the clients have been trading it. You've obviously kept a close eye on that.
I think sentiment is starting to turn. I mean, to be fair, they have been selling into the rally, which hasn't been particularly productive last couple of days aside, as you say. But the interesting factor is, as we do see the pullbacks, we're starting to see people buy into those. And I think, as you said before, the mood seems to have changed somewhat. As bear in mind how negatively we started the year, or around the turn of the year, around fiscal cliff issues and that kind of stuff. But the mood seems to be much more buoyant out there now. People are starting to believe the rally. So rather than you feel like you missed the boat. The market keeps rallying. It's quite hard to go in and pay for a new high. I think the psychology of the traders that we see. So although we have seen people selling into the rally throughout the month, certainly throughout the beginning of the week, we started to see people take a bit of profit, or they've been averaging in their positions, maybe get out of jail free with a 60-70 point sell-off, and started to use this as an opportunity to buy into the dips.
That's interesting. So having been short all the way up, now they're seeing this pullback as
on a relatively small pullback, as you said. I mean, you would normally expect to see that when you maybe reverse half and move out. I mean, but we've rallied more than obviously 120 points since the start of the year. So on a relatively small pullback, it seems to be people taking it as an opportunity to buy into the market. Okay, well, thanks very much. So let's see what non-farm payrolls brings for us tomorrow then.
Yeah, exactly. Thanks a lot, mate.
Thank you.